Hello, good evening, everyone, and a very warm welcome to this discussion today. And we are a regulatory technology company. We offer regulatory compliance management solution, which is called as GCMS, Global Compliance Management Solution. Beyond that, we have enterprise risk management and a litigation management software as well. Today, we are serving more than 450 plus entities, around 3,000 plus locations, and we have a team of around 95 plus lawyers and technology professionals who are working behind the scene in ensuring the software is up and live and the regulatory intelligence, which goes into our software, is updated on a real-time basis, not just for India, but globally as well. The team is based out of Jaipur, and we have our corporate office in Gurgaon and a presence in Pune, Mumbai as well, and then clients spread across India and globally as well. We have done projects in 70 plus countries, and today we have live clients in more than 33 countries as we speak right now. So very warm welcome once again to this discussion today. And let me quickly introduce you to both our speakers today. I have with me Mr. Parvinder Arora. We all call him Perv, so you will hear a lot. Many times I'm calling him Perv, so don't get confused. It's Parvinder only. Parvinder is governance compliance risk officer at Publicis Resources. Comes with more than 18 plus years of experience in compliance, finance, and legal functions. Have a very strong operational understanding about how things really work on ground, what are real challenges, and probably is a great friend. And I'll more than talking about law. I think there are a lot of other things which I find really soothing when talking to Parvinder. Very knowledgeable, somebody who talks out of passion. And while I didn't speak to you on this, but he recently he recently went on a spree of losing a lot of weight, and he lost 10 kgs by doing. And probably I think I'm going to do one more webinar on talking about that, because a lot of people above 40 like me need your guidance on that as well.
You have given a very good hype about me. I'm not sure if I will be sustained to that or not, but I'll try to do it. Thank you so much for this nice introduction. Thank you so much.
I'm sure everybody would enjoy listening to you. And we also have with us Mr. Ravinder, Vice President, Legal and Compliance and Company Secretary for Deepak Fertilizers. Ravinder comes with more than 20 plus years experience. With what a few interactions I've had with Ravinder, understanding about the subject. I think Ravinder, to the point, and very, very deep understanding and knowledge about the subject. And I'm really, I don't want to also say this. I found it very exciting and passionate about this subject. So I'm looking forward to listen more from you. A lot of case studies, a lot of real life examples, and thank you so much for your time, and welcome both of you to this discussion today. And also, before I move forward, I also want to mention that this is our 24th webinar in the series. We've completed 2 full years of our Lawgical Talk series with this session, and continuously for every month. And it could only be possible because of all the support from the industry speakers, from all of you who is joining us for these discussions. Thank you so much for encouraging us and bringing us to this level where we are able to bring so many industry speakers. Thank you so much, everyone. And also one disclaimer, Parv and Ravinder, they are coming out of the passion and love for the subject, and to share their experiences on the subject, which they know well. All of the opinions which they are going to share, which we are going to discuss today, they don't represent any of their organizations, any of their employers. It is all personal with their experiences, and please don't take it as a legal opinion or advice, because scenario to scenario, a lot of things will change. I think we need to do deep dive, but idea is to have a knowledge sharing on things we know better. And with this, let's get into the discussion. Mike, if you're there.
Yes, I'm there.
Great.
Hope I'm audible also. Yeah.
Yes, you are audible, Mike.
Yeah. Okay. So, good afternoon, everyone. Warm welcome to all of you to our 24th logical talk on the regulatory framework of related party transactions. It's great to have such a knowledgeable audience joining us today as we delve into this nuanced and highly significant area of corporate governance. So in this session, we'll be exploring related party transactions from both statutory and taxation perspectives. As many of you would agree, every company secretary, finance manager, and even director takes a pause before entering into a related party transactions, and I know they will check that, okay, are we allowed to do this, have we secured the necessary approvals from the board or the shareholders, or are we compliant under various statutes. So they will going to check every time. And since the inception of the Companies Act, I have often referred to these provisions as and when the situations arouse. As a company secretary, it's our duty to stay compliant with the provisions before entering into such transactions. Unlike other decisions where post facto rectification is possible, but in RPTs, RPT demand prior diligence and approval. So it is very important. Okay, if you are going to enter into related party transactions, then you please check whether you are allowed, whether you have obtained approvals or not. You'll be not allowed, or there'll be non-compliance after entering into the related party transactions. There are two fundamental concepts, basically related party and related party transactions. So we'll be exploring both through the following discussions. And interestingly, RPTs are the topics which we can talk for 5 minutes or 50 minutes and still find room for the debate. Okay, and every professional is like that, so connected, and every time they face such situation, they see, okay, whether I can go with this route or not. So everyone, there is a scope, there's a room for that debate, and we can talk on hours on this aspect. So in today's discussion, we will be covering how related party and related party transactions are defined across various statutes, and what constitutes an RPT as per Companies Act and SEBI LODR. Interestingly, every listed entities have to adhere both Companies Act and SEBI LODR simultaneously. And we'll be covering how to identify, recognize, and measure RPTs. Right. Basically, we'll be discussing from a financial point of view also. The approval mechanisms required for RPTs, how companies need to take approvals, and in what scenarios, in what cases they need to take approval from the board, from the shareholders. And the important one that we will going to cover is the roles and responsibilities of various stakeholders, whether they are independent director, statutory auditor, audit committee. So every stakeholder, every person, every key KMP, they are responsible for making such transactions compliant and good in view of the various statutes. The disclosure requirement mandated by the industry regulations and the taxation implications of RPT. So this is the comprehensive agenda of our logical talk, and we will be discussing in detail. Okay, this slides talks about the regulatory landscape, right? How so basically is particularly important, and see that what all statutes governing the related party transactions. Here, under the Companies Act, related party and relatives are defined in Section 2 of the Companies Act, and Section 188 lays out the specific provisions for RPTs, including when approvals from the board or shareholders are required. And there are the exemptions. Okay, for example, if the transactions are in ordinary course, then there is, that transaction may not be treated as RPT. So in this, I want to quote one line here, that every transaction with a related party may not be the RPT, but every RPT is necessary with a related party. So here, okay, if that transaction is in the ordinary course, we need to see that scope, the nature of that transaction, and it is in the ordinary course, that we may, you know, consider that as a normal transaction. For listed companies, the SEBI LODR regulations addresses RBTs in Regulation 23, covering definitions, approval mechanisms, and disclosure obligations. As we know, we have to, listed entities, they have to disclose at various junctures. Accounting standards, again, the companies adhering with the respective accounting standards, whether they are bound to adhere with IND-AS or the IND GAAP. So the accounting standards, they require companies to identify, measure, and disclose RPT in their financial statements. So, and what's interesting is that definition can differ when compared to Companies Act and SEBI LODR. So, the definitions which are there in accounting standards may not be same as defined in Companies Act and SEBI LODR. So, disclosure requirement that that a company secretary has to give pursuant to Companies Act and SEBI LODR may be different from what a statutory auditor has to give in their financial statements. NFRA, National Financial Reporting Authority, has also issued guidelines to enhance communication between statutory auditor and audit committee, and their aim to promote accountability and high quality financial reporting, so that the audit committee can also ask with the statutory auditor how they have evaluated, how they have disclosed those transactions in the financial statements. So that guidelines, that a document is important, for the statutory auditor, for the independent directors also. From a taxation standpoint of view, we all know Section 92 of the Income Tax Act focuses on transfer pricing regulations, prescribing how companies must compute their tax liabilities for cross-border transactions with related parties. So again, if companies are their parent, they are transacting with their parent company or with the subsidiaries companies outside the country, then Section 92 will get applicable, and they have to compute as per the Section 92, and they have to file their income tax returns and everything pursuant to Section 92. So yes, these are the regulatory landscape. These are the provisions which regulates the related parties. Okay, when it comes to definitions, so again, Companies Act, SEBI LODR are two important statutes to discuss. Section 2, subsection 76 and 77 defines the related party and relatives. And it includes directors, KMPs, and their relatives. Firms where directors, they are partners in those firms. Private or public companies where director holds stakes. Holding subsidiaries, associate companies, will be related parties. Again, if I talk about SEBI LODR, so SEBI LODRs adopt this definition but expand a little bit, right? So there are some additional points to it, that any member of the promoter group will be a related party. Any person holding more than 20% and in fact holding 10% of equity will also be considered as a related party. And any beneficial owner as per Section 89 of the Companies Act will also be treated as the related party. So these 3-4 pointers which are differently defined, which are additionally prescribed by SEBI LODR, what is defined in Section 2, subsection 76 and 77 of the Companies Act. So with that introduction, I would now like to hand over to our esteemed speaker, Mr. Parvinder, who will lead us deeper into the regulatory ambit of related party transactions. Over to you, Mr. Parvinder.
Thank you so much. Thank you so much, Team Lawrbit, for inviting me to this discussion. Sincerely appreciate this discussion. And let me tell you one thing, actually, at least I'm not an expert here. When I say expert, particularly in related party transaction, no one can be, honestly. If there is a expert, it's probably only the Supreme Court, wherein a lot of people go and things come out. So just to give you one example, what happens is businesses are failing only because of two reasons. Mainly, one is their business model gets failed, so other is corporate governance issues. And when you talk about corporate governance issues, 90% cases pertains to related party transactions only. So there's a hitch, there's a liking of the promoters to pass on certain extra favor in form of money or otherwise to their near, to either to themselves or to their near and dear ones. So that's hitch, that's the liking which results into this thing, and that's why there's a much focus on the regulatory side to control this aspect. At the same time, congratulations, Team Lawrbit, for completing this. I understand you are completing 2 years for this webinar. I was speaking to my team on this while preparing this, and my team told me that they have been active participant on this earlier. So I'm thankful to be part of this, because they have told me that's very popular in the particularly CSCA fraternity on this way. So coming back to a point of discussion, this is one of the major, not major actually, this is probably the most important chapter which chartered accountant, company secretary should know for compliance purpose. Not just for compliance purpose, even for their jobs, even if they are into investment, they need to look into this thing. I'll come back on this thing. So if you are, say, for example, a family man, if you're investing in Unitech, if you have invested your money in Unitech, you should be knowing probably you have invested in a wrong way, because Unitech ultimately paid the money to in terms of related party transaction, and you didn't get your house in time. Same is the case with JP, and same is the case with others. So in case you're an investor, again, I'm just giving a very high level thing. Let's not just focus on the secretarial aspects or company secretarial things. If you're an investor and investing in a wrong way, in a wrong company, which is doing some hanky-panky as far as related party transactions are there are list of companies, at least 25 companies, which have failed. Recent examples, previous examples, and not just even the size of Satyam got failed. I'm not saying whether whatever is mentioned in the media is correct or not, but at least 25 companies, more than 25 listed companies, big size companies have failed just because related party transactions were happening and things were not caught at the right moment. So that's where we need to be very, very careful as a professional, as an employee also, or as an investor. We need to be very careful what is related party transaction. So let's right now, since the focus of ours is towards more of the compliance side, let's focus on Companies Act. How we define as related party transaction. Since Companies Act governs all the companies in general, so the definition is little relaxed here as compared to SEBI LODR regular regulations, which is applicable only for the listed regulations. So if you talk broadly about Companies Act, Section 276, 77 covers this aspect, wherein certain sale, purchase, selling or buying of land or leasing of property of different kind is covered under these transactions. At the same time, not all transactions are covered, probably because it will be too minuscule to go to every extent. So they've created a certain threshold. I'm not sharing those threshold because I'm sure each one of us knows it. If we don't, we have a slide which we can quickly refer to. But yes, that's the objective of the law, that certain major transactions are covered under the Companies Act, which is applicable on all the entities. As far as related party transactions are covered. As far as this listing regulations is covered, the guidelines become more stringent. Reason being, now the public money is also involved in a big way. So any transactions which is happening between related party, listed entity, and between this subsidiary, which is not a wholly owned subsidiary, it becomes applicable. And there are lots and lots of examples wherein listed entities have through the maze of their subsidiaries or associate companies have diverted the funds, and that's where we have failed actually this year. There are certain exclusions also that wherein we issue the shares on preferential basis, because that's a capital transaction that is not included there. Payment of dividend is excluded. Buyback of securities are obviously excluded because it's applicable across the board to each and every party who is a shareholder. So that's what it's a broader purview, and we'll be discussing this thing in coming slides actually.
Hello everyone. Hope I am loud and clear. Jayant, hope I am loud and clear.
Yes, you are.
Yes, Ravindra, you are.
Thank you. Thank you so much. So, Jayant, I think kudos to you. The kind of initiative you are taking to educate, disseminate law and ensuring compliance. I think you are doing the absolutely right thing. Even you are helping the government that how the law has to be complied. I think first is that educate, give knowledge, and people understand the law. And this is your initiative. I think a lot of congratulations. Thanks. Please keep this initiative and do educate the professional and keep continuing this activity. I think it was 24th you said. Please continue. I want to see the 100th seminar. So best wishes for this. Okay. And Mayank, thank you for explaining the presentation nicely on the beginning, the regulatory part. And Parvinder, my colleague, my co-panelist, thank you for taking through so far. And we looking forward to for interactive session. Now, my question to the audience that how many of you studied Companies Act 1956? Just give a thumbs up in the thing. Who studied Companies Act 1956? Because Jayant, we studied Companies Act 1956. Maybe Mayank studied Companies Act 2013. So those who studied 1956, please give thumbs up, right? So actually, we are, migrated to the 2013 Act. We are the 1956 Company Act, guys. So when we studied Companies Act, the related party was very novice. What it was there in the earlier Companies Act. It was director who holding office or place of profit, or any contract with the director. So there are the only two major sections dealing with the related party, because in 1956 they don't think that there was any related party transaction happening, because they think that the companies do self-governance. They don't require any governance or any strict monitoring or measures. So the provision was very liberal in 1956. But what happened? Our legal system comes alert when there are some issue happened or some challenges happened. So in 2009, very famous IT company Satyam case came up. Then they say that auditor is involved, directors are involved, the family is involved, the professionals are involved, KMP is involved, everyone is involved. How the law is taken for granted. Then there was many committees, many subcommittees, and the Satyam was a global company. It was not just an Indian company. They have operation across globe, and the governance of India's governance standard was questioned. So that is a big dent on the Indian legal system, Indian regulatory system. So the government thought that, okay, what we are doing, the law is not enough. The Company Act is outdated. It is old. It is not catering to the new requirement. Then there was a committee, and then they formulated, and again suddenly this 2013 Company Act came in, where they've structurally you have seen the sections 188 and all that sections they have inbuilt, where they say that, okay, there is a related party transaction concept, and it has to be inbuilt in the law. Now you understand our ecology, the broad spectrum, why it is. In Indian business, most Indian businesses are family owned, right? So I worked in many multinational companies. When you go back to their shareholding, there are pension fund, there are mutual fund, there are government holding, there are public holding. There are very less family holding. Even if there are family holding, there are very less percentage of family holding. But here in India, if you see, even some companies, I wonder, they are listed company, the 98% shares are held by government, or 75%, 76% are held by the family-owned business. So the structure of Indian family business are more family-owned, majorly controlled by the family. So this created a problem. When you have profit, then they find an avenue to transfer the profit through the related party. Now, who is suffering? The minority shareholder. If you are a public shareholder and the 75% shareholder taking away your profit, you don't know anything. And it is in the garb of a transaction. I am entering a sale, purchase, or property transaction, but I'm doing it in abnormal, high profit or low cost, but I'm transferring the premium property as a transaction. So that has created a lot of problem. If you analyze the Satyam case, it is a classic example where how this related party transaction, how they create wave of subsidiaries, and in the garb of transferring fund, in the garb of doing new business, they've diverted entire fund. They've taken loan from the bank. Even the recent ILFS case, we know very well, it is there in the public domain. What happened in ILFS case? They created a wave of subsidiaries wherein in the name of investment, they transfer the fund to the subsidiary companies, and from the subsidiary companies you are diverted. The auditor is involved, the KMP is involved, everybody is involved, and who lost the money? The investors and the banks, right? So ILF is like company who are funding to the infrastructure. The banking system, the stock market system collapsed. Now, if we don't have a strong regulatory system or a strong regulatory governance mechanism, then the capital market, the system, everything will collapse. Now we are thinking of investing our pension fund, the provident fund, the social security fund, the saving, people saving money, they are going to stock market. But if the stock market is a bubble, or the companies who are doing this bubble, then what will happen? So this is a big concern. It is not just a small problem for the professional. It is also a big challenge for the government as well. Government want that stricter provision, stricter compliances. That is why you see every 6 months, I am just observing recently, every 6 months, some new regulations, new guidelines, all these are coming on the related party. Now, recently you saw the biggest fintech company, we pay money through that app, right? They have been warned by SEBI that you have violated the related party transaction. You have not disclosed, you have not done that. Despite all the regulation, despite all the compliances, what is the role of auditor? What is the role of KMP? Right? So still the provisions are getting violated. So what is the role of government now? Government getting it more stricter and stricter, right? Now coming to the point of discussion today, before joining this listed company, I was in a private limited company where the auditor asked me, what is your related party transaction? I said, we are 100% funded by multinational company. What related party? Whatever we have, it is on the arm's length price. There is a cost plus markup, there is arm's length, and there is nothing, right? And we don't have, we did not have the audit committee as well. So just noting in the board that these are the related party transaction, it is disclosed in the tax audit report. You know, the tax audit report has also the related party transaction. So the disclosure is to be required under the particular form. So once you disclose in the tax audit and just noted in the board meeting, your compliance is over, right? Now, in my previous telecom company experience, that company was a publicly limited company, but it was not listed. So there again, we have audit committee. So when you have audit committee, then it is bound that the related party transaction to be placed before the audit committee. So there are, and if you have the loan or the exposure with the bank, you are borrowing, then the borrower will question, what are your related party transactions? What are your transactions with your family owned KMP person, all that. Okay. So then there is a little bit more concern. But when you are a listed company, whose money it is, whose wealth it is, and the wealth has to be managed properly. So when it is a listed company, you saw the LODR regulation, and you recently saw the industry standard came out with the industry. It is a minimum disclosure, right? So the compliance is absolutely necessary whenever it is a listed company. One has to ensure the compliance. So if you have a robust related party transaction governance mechanism, what happens? It prevents conflict of interest. And we all know the audience is chartered accountant, company secretaries, learned lawyers, professionals. We know what is conflict of interest, right? So this will definitely prevent conflict of interest, and it will ensure enhanced corporate governance. The route to financial mismanagement will also be avoided, and the minority shareholder get protected. Above all, the other stakeholder like your employees, your banks, your government, everything, because you pay less tax also. The government is also involved. If you have a related party transaction, you are not disclosing proper profit. You are siphoning fund, right? So government is also biggest stakeholder. Actually, we work 30 days in a month, 20 days for us and 10 days for the government, because we pay 33% tax, right? So 10 days for the government. So government is our biggest stakeholders.
Sorry, I was speaking and I realized I was on mute. So thank you so much, Ravindra. That was very crisp and makes complete sense. What you said is how it shaped up, how it's shaping up in India. So now we can discuss how to recognize, how to value, and how to measure basically the broader parameters which are applicable for the related party compliances. The first thing is to identify related party transactions, and wherein the disclosures given by the directors at the time of their joining and subsequent whenever there's getting changed becomes very handy. I've seen certain companies wherein this is just taken as a normal compliance. It's given by the board of the directors, gave this document to the board for its noting, and it's sent to the board for the noting. But the accounts team, sales teams are not getting aware of those things. They are not aware that who are the related party transactions. They are not aware who is the related party. How will they comply with it? They will never report it. So that's very critical for any company secretary in particular here, that whenever there's a disclosure coming from the side, from the director side, this needs to be aptly disclosed, apart from being disclosed to the board of directors at every level wherein that transaction is supposed to happen. Because if you are working for a big company in particular, there's a chances of this thing getting clicked and you may not be knowing actually, and at a later date you'll come to know. So identification is the first challenge. Then you need to identify if there's outstanding balances and existing commitments with the related parties, because you need to aptly capture it in case approvals, if you have not taken by any chance, if you have missed it, you have to take it the corrective action as soon as possible. You have to do once you do that, you have to take the assessment route, what best things to be done to be compliant as far as Companies Act is concerned, as far as income tax is concerned. Applicable laws we need to take care of, how it is, whether the disclosure is requirement, whether any approvals are required by audit committee, board or shareholders. Everything needs to be taken care after this is diagnosed. If it is already taken, if a related party transaction is already done. If it is in future, of course, then you will take care of those things in any case. So whenever there's a change happening, we need to check with the promoters or the KMPs or the other parties if whatever the changes is happening within there. So it may happen that some entity which was not a related party transaction 10 days back suddenly became a related party transaction because certain changes has happened. So it's very dynamic, and we need to be aware of what's happening on the ground. So and first, not to avoid any compliances here. Once it is done, you have to acknowledge one point, that all the promoters may not be able to visualize that what is the requirement of disclosure. Even in the basic document like MVP1, they need to be probably told that, okay, this is for an entity which may not be applicable for you to disclose it, but it will be the right idea because it may trigger because of XYZ reason. So it's better for you to disclose. And there's another theme which rightly said by one of our famous businessmen: when in doubt, disclose. So wherever you are in doubt, disclose. That's the best way of corporate governance. So you need to tell them, yeah, you please disclose it in your MVP1 that this may fall in, in certain layer may fall in the related party transaction. So better disclose. Then you have to value it. And first thing is to ensure that the transaction is being done at the arm's length price. If it is not done, we have to do the necessary adjustments over there. We need to ensure it's transfer pricing as far as company income tax act is concerned. We have multiple methods thereof, and we can choose for the relevant methodology there. We have to maintain certain documents and disclosures for any future reference or for board reports or for any audit and all those purposes. We are all aware of those things. We need to disclose as per in AS or AS requirement. As for CORO, we need to report. We need to maintain certain registers. We need to inform in the board of directors report as per the notes to financial statements. So all these things need to be covered, and comprehensively this needs to be covered so as to ensure that we are within the regulatory framework. We are covered in a proper way, and nothing comes on our head or our management and company is also protected there.
Great. Now you have done the recognition, you have done the valuation, you have done the measurement, right? You have done all the three. Now, when you have done the recognition, valuation, and measurement, what you find out? It is a related party transactions, whether it is within the threshold or outside the threshold, right? So now you have identified everything, that what is the nature of the transaction and with whom the transaction is Big Mac. Just give thumbs up. How many from this audience are from the listed company? Just thumbs up. How many are from the listed company? Just I want to understand how many people from the listed company are present, so that I'll more focus on the listed company or on the unlisted company. I'll go. Okay. So few from the listed company I could see. Let me go with the listed company first. Now, those who are in the listed company, they are very much clear about the omnibus approval. So before the beginning of the financial year, you know that this kind of transactions are routinely happening. So you take a omnibus approval for the financial year. This much transaction happen. Okay. Now, if the transaction exceed the omnibus approval, right, then you have to again go to the committee and take the approval, right? So, and it is the prior approval. It is prior approval both from the audit committee as well as from the shareholder. So there was a discussion with my team. They were checking whether after entering the transaction, can you take the shareholders approval? Because as per the S Court and Supreme Court judgment, approval need not be prior approval. If the law says approval, you have to take the approval from the shareholder. It need not be prior approval. It can be post approval also, as per the legal interpretation. But if the law says that it has to be prior approval, then you have to take the prior approval. It cannot be the post facto approval. That is the legal position. So the legal point is clear. Here, the legal point is that it has to be prior approval. So you have to take the audit committee, board, or as the case may be, if it's a more than threshold, then the shareholder approval, it is a prior approval, right? So obtain all the approval, then you have to submit the stock exchange, whatever the necessary disclosures, okay? And if during the year you have to monitor it, how much I have taken the approval and how much is pending. If it is a more or less, accordingly you have to, if it is a less, it is okay, but if it is a more, then you have to take the fresh approval, right? But when it is come to the unlisted company, then you have the audit committee and you have the board approval. The situation is a little bit less complicated if you are unlisted. Only the company law applies. The LODR norms or the industry norms, these are not applicable for the unlisted company. So the life is a little simple. You have to take the audit committee and board approval, but again, it is also prior approval, right? And if it exceeds the limit, then you can go for the shareholders approval, right? Now, despite all these clear provisions, still there are very interesting cases. What you should know is the Supreme Court judgment on the our Cyrus Mistry case, very famous case, very well argued by the biggest lawyers and all that, wherein it was found that there are ample number of related party transactions. There are questionable on the independent directors. There are questionable on the board governance, right? So don't think that the transaction I am doing today, it is within my books. It will not go outside. Please keep in mind that you have many stakeholders who will blow the whistle. You have the whistleblower, you have the auditors, you have the secretarial auditors, you have the KMP, you have your employees, you have your taxation department, you have your GST, you are subject to so many audits. It will come out. Okay, so be mindful about it. So again, another big judgment wherein the SEBI has found it is a fund diversion, a misrepresentation of financial statement, and auditor not agreed to sign, because when auditor pointed out this related party transaction, management did not agree to the auditor's finding. Then what auditor will do? Auditor said, no, I will not sign the financial, because there are related party transactions and you have not taken it. The management said, no, these are not related party transactions. Then auditor has to put down, right? So these have a lot of this complication, and SEBI has a lot of power to give you the penalty. And in case of unlisted company, Ministry of Corporate Affairs, they give the penalty. In a classic case, I tell you, where what happened that this related party transactions are also to be disclosed in the board's report. Whereas auditor has disclosed in the notes on account, whereas the board has not disclosed in its disclosure requirement. Then there was a SOCOS notice issued, and then the MC has issued the penalties to the penalties on the directors and the KMP. Similarly, one big listed company, I cannot name, they are into a lot of this Hindenburg and all this issue comes when there is a special audit by the government. They also found to be on the related party transaction violation, and the MC has levied penalty. All these are there in the public domain. If you want to more about these cases on the related party, you please educate yourself that these transactions have a lot of consequences. So be mindful, and it is always better to comply. Thank you so much.
Sir, I have few questions with respect to this slide.
Okay.
Sir, does shareholders' approval required for a transaction entered into by an unlisted subsidiary, not wholly owned, with third party, which is material in nature?
Yes, if the threshold is violating the threshold limit, it has to go to the shareholders. Yeah, and it is a disclosure requirement. So, if you don't have any problem in disclosing to the shareholders, I think it is a better governance that disclose to the shareholders.
And sir, can omnibus approval for repetitive transaction be avoided for entering into a long-term agreement for such transactions?
No, even if the long-term transaction, you can, but it has to come to the audit committee. It has to be placed before the audit committee, even if in the long-term transactions, but the validity is 1 year. Every year you have to place it. So the law requires that every year this transaction has to be placed. But in a long-term transaction, I think, see, it is, you are not going to the government for approval. It is placing before the audit committee. So what is the point in disclosing to the audit committee that we have a long-term transactions? It is noting of the long-term transaction, which is entered into in the year 2024 or 2023. The transaction is entered, it is going on. So the validity is 1 year as per the law. So I think as a better governance, I would recommend that please place it before the audit committee or the board if required, and then get it noted by the board or the
every financial year, in the first board meeting of that
yes.
particular financial year.
Yes, absolutely.
Okay. So, but the companies can enter into a long-term relationship, but they
absolutely.
have to take the approval every year, every financial year in their first board meeting. Right?
That we say is a ratification. You ratify in the board. You just place it and note it, because this transaction is in principle agreed for the long-term view or whatever, it's agreed, but it is a ratification. You just place it in the board. Board has duly taken note of the transaction.
Okay. So for the listed company, all modifications or only material modifications shall require approval of the audit committee in case of listed companies.
I'm believing in governance more. So you are not going to the government for approval. It is your audit committee, your board of directors. It is better to disclose your audit committee and your board, even if there are minor modifications or there are some change in the terms. It is better to place before the audit committee and board.
So what are the important documents to be checked before entering into RPT, and what are the important documents placing before the board?
So I think all the transactions, if like if you are buying a shares, then there is a valuation report, and there is the independent auditor report. Then there is independent professional report. Sometimes these transactions are very technical nature, where the board is not competent to decide whether the transaction is at arm's length. This transaction is actually required for the company. So do you have the independent valuer? Do you have the independent professional certification? Do you have the independent chartered accountant other than your auditor? Do you have the independent body who certifies that the transaction is in arm's length? It is in the fair price of the market. This is required for the business of the organization. So I think it has to be educated to the board, and whatever the document, minimum document is required to be placed. But now the independent directors are very particular. So I have the experience of couple of board meetings where the independent directors, they are very clear about it. They say that, boss, you give us all disclosure requirement. We to our comfort, you place all these papers, right? So the audit committee itself, they are learned professionals. They ask for a lot of these disclosures. So I think complete disclosure should be given, depend on the requirement of the transaction, how it is. But on the financial, on the technical aspect, you have to give them the independent report.
Okay. So one more question I have, whether section 188 covers transactions such as receipt of reimbursement of expenses on actual basis from a subsidiary.
Yes, absolutely. Reimbursement of salary, reimbursement of expenses, everything, it is disclosure. You are paying what you are paying, reimbursing whatever is a transaction. You place it before the audit committee. These are all the reimbursements were paid. These are the reimbursement. Sometimes the employees of holding company work with the subsidiary company, or there are some transactions, there are salary payment, there are whatever payments. So it's in the governance of better disclosure. Even if it is a reimbursement of actual expenses, why it is not disclosed? So I believe in disclosure.
Okay. Thank you. Thank you, sir.
Thanks, Ravindra. I love the approach when you said, when you reaffirm the fact that when in doubt, disclose. When in doubt, disclose. That's the best way any new profession, any new CS professional can learn. And that's the best way to, in case the management is not getting comfortable, that's prima facie is not a good sign for the company secretary. That's prima facie, of course, I'm saying. So, but I like the approach, a very valid and practical approach. Whenever you are even in slightest doubt, disclose and take the approval. It's your internal audit committee only. They should know what's happening within the company. They have the full right to know it. Thank you so much for that. So let's now move to industry standards. How for listed entities, how and this information is being shared with the shareholders and people at large. So first of all, there has to be uniform and clear disclosure format for RPTs. Whenever we are seeking any approval from the audit committee or board or shareholders at large, we need the requirement should be very, very clear that what we are seeking for. And as you rightly pinpointed, the documents, and these are not necessarily the documents which are just contained in the statutory bodies. If you think there are additional requirements which may be helpful for the decision-making process, should also be included. Point well taken. Thank you so much for this. Information, so there's one important element which comes when we share the information with the shareholders. That's explanatory statement, and there's a law governs. The law provides many things which needs to be covered under this explanatory statement, because this comes as a special business in the AGM or EGM notice. So there are specific requirements in that. And again, if there's a doubt, I'll request you to please include that as information even in the explanatory statement. So your position is absolutely clear. What are the applicable transactions? We have slightly covered earlier. Just to reiterate this thing, material RPTs has been defined. Materiality of the transaction, audit committee has been advised to devise that what is the materiality impact. What is the materiality for a respective listed entity which they can devise on their own? The power has been given to them. Transactions with a related party where the transaction is to be entered into individually or taken together with previous transactions. So cumulative transactions, if it exceeds certain threshold, that is 2% of turnover or 2% of the net worth of the company or 5% of the average of absolute value of profit and loss account, it needs to be disclosed. It will fall under the definition of related party transactions. This is happening now. The D-Day is 1st July 2025. The RPT for the listed entities will start from 1st July. That's the thing. And unless there's a question, we can move ahead for this.
We can move ahead, sir.
So now we have discussed that, the ecosystem has to survive. The financial ecosystem has to survive. Then only with now how much it is 1.4 billion or 1.5 billion population we have. All this 1.5 billion depend on this robust financial sector. Now, if the industry is also concerned, right? Industry also don't want that the trust. Trust in business is the most key consideration. So the industry, CII, FICCI, SHOM, all they formed a committee, and they say that we have to bring the credibility on this related party transactions. And they say that, okay, these are the minimum disclosure required to be made. This minimum disclosure is to be made. So if it is a material related party transactions, then where the disclosure is required, it has to be disclosed both in the audit committee, shareholders, and it has to be comprehensive disclosure, right? And if the related parties with promoter group, it is again a comprehensive disclosure, because again, this is transaction between the entity and the promoter group, right? If it is a residual RPT, it's a limited disclosure. So the trust is when you are dealing with your own relatives, then please give complete disclosure, right? And if it is a substantial amount, substantial value, give complete disclosure. But if it is a nominal, right? If it is a salary paid to a professional, if it is a routine nature, just minimum disclosure required. So that is what the industry also want. Industry also want that as an ecosystem, everybody should thrive. Yeah. Thank you.
we've already broadly discussed what are the requirements for the company secretaries in particular, or KMPs actually. Broadly, we've covered what exactly is the requirement, what the documents are required, and what they should produce for the audit committee or board or shareholders meeting. Now we can discuss what exactly is the requirement from the independent director. Independent director, basically they are the guardians or trustee of the business and they're appointed on behalf of the shareholders. So they need to take care. So that's here. Independent directors, if you see first audit committee, it consists of majority of independent directors. So they want to the regulatory environment wants to ensure that everything is getting aligned in a proper way. So that's their first thing. That's the first requirement from their side. They need to ensure that this is as per the arm's length price is happening or not. If it is not at arm's length price, what exactly is the reason, and if it is justifiable or not. So that's the thing they need to ensure. And it needs to ensure that if it is an ordinary course of business. If it is not an ordinary course of business, then appropriate disclosures and approvals needs to be taken. The crux is that they need to safeguard the minority shareholder interest and upkeep the ethical standards. And that's exactly, if you see our some of the listed entities or the directors have failed miserably. If you take so many examples as we were taking, have failed actually here. They didn't disclose things. They didn't take the corrective actions. Probably they didn't either willingly or unwillingly. So they might have missed the document as per the news or actions taken by the regulatory authorities with them. But these are in the public domain. You can see there are Gensols, there are Jet Airways, there are Kingfisher Airlines. And if you go there, so many things they again refer to that probably independent directors had not taken the proper work over there. But that's if it is expected from them. And again, same goes with the statutory auditor or audit committee also, that they have not done their work properly, and that's where it led to. And that's where, as a company secretary, that's very critical role, or as a KMP, their role is very critical in giving the rightful information or the guidance in that regard to the board of directors or audit committee. That we need to consider this. We need to consider this is also required as per the law. KMP, what exactly needs to be done? We've already discussed this thing. As an investor, we need to be very mindful because it's our money. We need to when we are approving these related party transactions, we need to take certain precautions before approving it. Actually, if it is in our long-term interest of the company or not. And that's the basic criteria which we need to fulfill here. And that's how it sums up.
Okay. So now the audience question. How many of you think that accounting standard is applicable only for the auditors, not for the board or the company? Please thumbs up if you think that it is only applicable for the auditors, not to the company. This accounting standard is applicable only for the auditors. The accounting standard is to be looked by auditor only. The board or company is not responsible for the accounting standard. How many of you agree? Please thumbs up. Great. So the point is, in the board's report, you declare that company has complied all the accounting standard, right? So this accounting standard is also applicable to the board as well as the management, right? So it is not just for the accounting standard is not for the auditors, right? It is also for the board members. That is what I want to emphasize. Now, there are additional disclosure. The auditor has to also satisfy that all these transactions at the arm's length and they are properly disclosed. All the material transaction, everything is properly disclosed. So we have the accounting standard, which mandates our auditors that all our financial statement, everything prepared in a proper disclosure manner.
Sure. So there's a ICAI Guidance Note which clearly calls out what is the requirement disclosure as far as related party transaction is concerned. And these are the basic things which you can see here. Name, relationship, and description of related party transaction. Basic details, volume and pricing, all this stuff. Amounts or proportion to outstanding items related to each RPT. And you need to calculate it with reference to your turnover or net worth accordingly. Total KMP remuneration, which in any case we do it as per the audit in our directors report by major classes and loans directors, which is not available widely or known to non-KMP individuals. So this is another thing which you might have heard recently, which has happened, that there's some loan which company offers only to a selected class or a premium class of people, and this premium call of people person is called as known as related party. So that's, if this is coming, that we need to clearly call out in our report as far as the ICAI Guidance Note is concerned, and that's, and if you see there are practical issues, this is again a red sign in case this such types of loans are happening. This is a red sign, a danger sign for any investor or other people who have interest in the entity. There's a little danger sign which is reflecting which something may not be good, which is linking us towards that. May not be conclusive though.
So this is the minimum requirement. This is the minimum requirement as per the industry standard. So the guideline came out, which is applicable from July. It was 3 months delayed now. June, July, it is applicable. Exact date you check. So now they've given the table that for these transactions, you have to disclose this much information. This is a minimum requirement. You can disclose the maximum, but this is the minimum requirement you have to disclose. So they've prescribed the minimum information to be disclosed in a related party transactions, depending on the material transactions. You are paying royalty, you are paying salary, commission, you are having a purchase, sale of any property, or you are issuing securities. Depending on the transactions, what are the minimum information you have to disclose? The industry has prescribed the minimum disclosure information, right?
Sir, there is one question around this slide from audience, Mr. Srinivas. Okay. And they want to know, are these information shall be placed before the audit committee before 1st July, since these standards will be effective from 1st of July, but whatever the board meetings happening before 1st July should be place the information as per this standard, before 1st July?
Yes, I think there is a discussion happening. There are some gray area. That if you have already placed in the financial year, because July is the mid of the financial year. So should we do it again? I think there are some clarification issued in this regard, and it says that I have to check that clarification exactly. But I think, to the best of my knowledge, that again placing is not required. We have already placed it. But if the transaction is new or novice kind of thing, it is your audit committee, better to place it twice. So I believe on the governance side. So disclosing to audit committees is not a problem. So better to disclose than to hide.
Thank you, sir.
So these are the tax implications on related party transactions. We've already discussed the Companies Act and listed listing agreement, listed requirement. Now, there are tax implications of related party transactions. Now, what happens is that arm's length pricing, we need to determine the arm's length pricing. For that, there are certain methodology prescribed by the taxation rules. That's we need to find out, and we need to apply the apt rule here. And in case there are multiple apt rules, then we have to simply make the average of that, and that will become our arm's length pricing. So that's so there are major rules where certain valuers can be appointed. If the value is significant, we can appoint that and reach out to the arm's length pricing, so as to ensure and give the comfort to the audit committee and the board that whatever is happening is comfortable and within the arm's length pricing. So they are protected also in the future, friends.
Yes. So tax implication, we are better in the tax rates, kind of very high, country like India. So sometimes promoter want to cut the corner. So how the promoter can cut the corner? They want to reduce they want to inflate the expenses. So how you inflate the expenses? If you sell 10 rupees product to 20 rupees, or you buy 10 rupee product 20 rupees, so that you book the profit in other company, but you lower your tax in one entity and you transferring the tax to the other entity. There are a lot of these transactions are happening in the market, and so that is why they say that if there is a related party transactions there, then it has to be at arm's length. Otherwise, there will be a tax implication. Same with import. If you are importing any goods, there is a concept called transfer pricing. At what price the products are brought or sold to your subsidiary company in India, right? In the global company, they have the 100% subsidiaries across the globe. So they they make the product at a price, but to inflate profit or to divert the profit from one country, one jurisdiction to another jurisdiction, there are a lot of these technologies or methods available for ciphering or the avoiding tax. So the related party transactions also comes in the transfer pricing concept. So transfer pricing is one example where you have to cost plus markup, or you have to define that how you are determining the price. Okay, and you have to say that it is at arm's length, and you have to prove that it is in line with the market price or in line with the market practice. So these are all the tax compliance. So the related party violation will attract into also the direct and indirect tax violations. So that is what the object of this communication.
We have covered all the slides, sir. So now we can take the questions from the audiences, and there are some questions which are listed here in this presentation also. So there are some questions from the audience. If you allow, sir, can I take those?
Yes, please.
Okay, so Ms. Binu Sharma is asking why 20% modification criteria are considered by companies for defining material modification as part of RPT policy.
Yes, okay. So if you are modifying at 20% to the original approved transaction, I think then it is a material modification. 20% is a huge number. In a 100 crore contract, if you modify 20%, it becomes 125 crore. It is more than 25%. If there is a minor thing, then it can be said that okay, it is not a material. But if it is more than 20% minor, I think it is a justified from the governance perspective. But from the operational or day-to-day inside company perspective, it may be a little bit challenging because it requires procedural complexity. Because again, you have to call the audit committee. The business cannot wait to close a transaction because it requires prior approval. So there are all difficulties. But on a governance perspective, I think 20% I feel is a reasonable. This is my personal view that 20% is a material thing. Yes.
Thank you, sir. So Mr. Nitin Mehra has a couple of questions. So basically, the first one is RPT is under the contract and arrangement. At what stage the RPT is to be taken? Is it required to be taken before entering into the contract and arrangement or after that?
It is on the signing actually. It is before you sign the contract, before you get into the deal. It is not on the discussion stage actually. So when you are signing, when it is the finalizing, then you have to take it. But I also, Parvinder, your view on this?
It has to be taken prior. It has to be taken prior. That's my understanding. Yes. It's very clear. Reason being, if this is not get approved, all your exercise goes into vain. It has to be done prior.
Another question.
Otherwise, you have created already obligation. You have signed the agreement. The obligation already created. Then the audit committee has. They are just the rubber stamp. So I think the object of the law is that prior approval. So before the contract signing, you have to take the prior approval. Yeah.
Okay. So another question from Mr. Nitin that can omnibus approval be given for RPT on ordinary course of business, but not on arm's length? If no, what is the requirement for arm's length basis?
So again, if it is not on arm's length, then arm's length price, then then it is not complying. The audit committee cannot approve. Then it go to the shareholders depending on the threshold, limit, value of the transaction. It go to the board and then go to the shareholder.
So and I think, sir, it can't be said. It can't be considered as ordinary course of business also. But it's so if it is not on arm's length.
Yes. Yeah. So you are right. If it is not. Then it has to go to the next level of approval. Yeah. Right.
Next, from Mr. Nitin, that there are some listed companies who are taking interpretation that RPT between holding and wholly owned subsidiary in ordinary course of business and on arm's length basis are not required to obtain audit committee approval. How correct this interpretation? As it is they are exempted under LODR, but they are required to do under Companies Act.
here the requirement is that if your accounts are consolidated with the balance sheet, the exception is provided in the LODR only. If the transaction is between two wholly owned subsidiary or between your 100% subsidiary where the accounts are consolidated, it is not required, but this is the law, this is the regulation, I think. Yes, this is the exemption provided in the regulation.
Exemption is provided, but it will certainly be helpful in case the audit committee approval is taken by the holding company. Again, because they need to be aware, we may be exceeding what is required in the law, but that is in the interest of the company, the management, and the KMPs. That will be there. Okay, so there could be one exception. There's certain hurry. You need to go and enter to the transaction. That is fine. But immediately after that, if it is the case, go and inform the audit committee and take appropriate approvals.
There's one question from CS Mehboob. They're asking omnibus approval cannot be taken for financial year 26-27 as minimum disclosure standard will be applicable by then. So whether omnibus approval will become obsolete?
I think at the beginning of the year, you have to take the omnibus approval. That is my understanding, that at the beginning of the financial year, you have to take the omnibus approval.
What's your take?
I have no idea on this. Sorry,
Okay.
I need to take into this thing because it's a development which I'm not aware of. Sorry for that.
Another question from CS Mehboob, whether minimum disclosure standard will be applicable for transactions between subsidiary of listed entity and its related party? Rabindra sir?
What is the question? What is the?
So whether minimum disclosure standards will be applicable for transactions between subsidiary of listed entity and its related party?
Minimum transaction and subsidiary party, I cannot certainly say, but we have to check it again. I'm also not sure. The related party on the industry standard disclosure has a lot of gray areas. We have to read the fine print and come back that how it is. Yeah.
Mike, I can suggest one thing in case there are certain questions which we may not be aware of. But we probably, in case you can email us, we'll try our best to get our information on that and we can come back on that.
Yeah. Sure, sir. So while circulating the recording, will circulate the answers of those unanswered questions.
Yeah,
sure.
There's one question from Mr. Jitendra Sharma. Can appointment remuneration of CS is considered as RPT or requires approval from audit committee?
No, I think it is only accounting standard. You have to disclose the KMP person. It is not the related party. It is to be disclosed as per the accounting standard because we saw in the accounting standard it has to be disclosed, but it's not a related party.
Thank you,
the
sir.
appointment of CS or any KMP has already gone through nomination and remuneration committee. It has already gone through that chapter. It goes for regular information to the audit committee and board. Of course, it will in any case it will go to the board in the board report and everything. So it's actually all two committees and board. Everything is covered here for the CS and all KMPs remuneration.
Thank you, Professor. There are no more questions. I think one more is there from Mr. Nitin Mehra again. ICSI clarified as per section 177(4) of the Companies Act 2013, approval of the audit committee is required for a RPT between the holding company and its wholly owned subsidiary company in the ordinary course of business and on arm's length basis.
What's the question?
So the governance perspective, it is better to disclose. Like again, ICSI and everybody want that disclosure. If there is a transaction between subsidiary and wholly owned company, still it is a transaction. It is better to disclose in your audit committee, right? But is it a mandatory disclosure? Has it to be done? Then I think the fine print and the interpretation need to be checked.
Thank you, sir. So there is another from Ms. Meenu. For transaction with related parties entered by director for which approval of ACM was not taken, and in 3 months the audit committee also do not rectify it, so will those transactions be void ab initio and recovery be made from director?
So the law says that it is a voidable at the option of the audit committee. If you see the LODR requirement, the transaction is voidable as per LODR requirement. It's voidable at the option of the audit committee. Right? But is the company listed, unlisted? We are not clear. So it depends on the facts of the question actually. But listed company, it is voidable. But unlisted, still we need to check the Companies Act provision because LODR not applicable there.
In fact, it becomes voidable at the option of the company. That's one. In case any loss is suffered or any expense already incurred by the company, that can be recovered back from the director also.
Yeah.
During this duration, yes.
Thank you, sir. So we have covered all the questions from the audiences and whatever questions that we have during the session. So thank you so much. Over to you, Jain, sir.
Yeah. So before couple of questions. Now these are not as such questions. They're. I just want to get your perspective on a couple of things. So we are seeing a lot of cases of late in the last 1 year. Also, there are a lot of cases where we have seen high-profile companies, well-known, celebrated ones, and then they are under the lens of various agencies because of the related party transaction. They may not be primarily listed companies. There are some private limited companies. Now, if it's such transactions, such failures are, I would call it governance failures also happens. Now, who owns the responsibility? Does the company secretary has a responsibility to it? There is skin in the game.
Absolutely, the directors, KMP, and if the auditor is also neglected, they have also skin in the game. So all first the board, KMP, and auditors.
Okay. So to my understanding, CS is also liable. But CS is also the primary responsibility vests on the company as well as directors. Reason being, they have the position of trust with them. So there's a trust factor which is additionally assigned as per different already decided cases. There's an additional layer of trust which has been assigned to them, and on that basis, that they have the primary responsible. But company secretary, any lapses which requires to be done under any statute which is not covered, he will also become liable here.
So the point is, I mentioned KMP because the CS and the CFO are the KMP.
Sorry. Yeah.
Because sometimes
the point taken.
Yeah. Yes. So the point is, sometimes what happens, practically, if some payment goes or some contract happened, the CS is not aware of. How the CS will know whom the payment is made? Only CFO knows, right? Company secretary is not signatory to any of the financial, the bank signing, check signing, sometimes the agreement signing. Company secretary is not part of it. How he cannot supervise everything. What is brought to his table, he will know that. And in the criminal law, the mens rea, what is his knowledge? So that is why the KMP, CFO knows everything on the financial challenges or the financial operation of the company. So I think the first CFO and then the CS.
No, second question is now in the last few years, I'm sure in the private in the listed companies, the large listed companies, there are strong governance mechanism there, that you have audit committees and independent directors. They bring a lot of sanity in terms of related party transactions. But are there still challenges in the boardroom? Are there still challenges with the management? Because there are reasons why the related party transactions happen, where you feel that it becomes a tough situation to even educate.
So Jayant, related party transaction per se is not bad, I tell you. Sometimes these are mandatory. So there is one asset which is shared equally between all the group companies, right? There are some facility created. There are some unique thing which is shared common, and the expense is shared. So it is a related party transaction because it's owned by one group company, then other group company sharing it. There is a one corporate head office. Other companies are availing the services. There is a one resource center. All are availing this. These are all common practice. The related party transaction is not per se bad. It is very essential and day to day. Only thing is that disclosure. And the law also not say that you go to the government for disclosure or go to any other person for disclosure. It is a disclosure only with the audit committee, board, and your auditors. So So I think disclosure and governance is the key here, and so that is the point.
Great. No, thank you so much. No, I think this gives a lot of perspective. And sorry, one last question I forgot to, for a CA institute, there are code on ethics. Do you have anything similar for CS and
Absolutely.
does,
It's a
does,
it's a go ahead.
No, I'm saying is that, does these codes cover anything around RPT and disclosure on RPT, which is more rather than a compliance requirement, is also an ethics requirement.
So again, first educate. So educate whom? Your finance team. Educate your finance team that this is the related party transaction requirement. If sometimes this transaction happens out of no knowledge or the lack of knowledge, right? So first educate and create a system in your organization, train to the people, those who are dealing, and these breaches are sometimes bound to happen because people go with the flow. It's in the day-to-day transactions. It is happening, so it's happening, right? Sometimes educate and create a system of compliance, and it comes over a period of time. I think so. That is the thing. It is because we are good talking in a room, discussing about the law. We say that okay, follow, do all compliance. But in a business scenario, it is not very practicable. So many transactions, so many things are happening. So many things happen in a genuine, in a good faith, right? There is no intention of violation, but the violation happens, right? So educate, follow, practice, and then create a governance this thing. So this never comes in a short term. It comes over a period of time.
That is you pointed on a very important aspect, and I always talk that in India, one thing which we are missing is more on education. So we say compliance. You're supposed to know your compliance. If you don't do your compliance, there's a penalty. We don't say there is a remediation, and we don't talk much about the education in between, because there was many times, as you rightly said, the non-compliance happens not because of intention, but unawareness sometimes, or because there is a thin line somewhere. And I specifically, ask this question because today when we're seeing there are a lot of new age companies, which we see they have a potential to change the future of the company, because when a startup is founded and they suddenly grew in 3 years, maybe there are no mechanisms in place. There are no right set of knowledge is available, but suddenly you find them on the wrong side of a related party transaction. And I don't want to talk about, I don't want to give a judgment on this, but I don't know how bad the situation is in Blue Smart. Sometimes when you look at what you read, I think it's over exaggerated also at times, but the damage has been done to the company. Maybe some intentional, some unintentional, but I think you rightly said, I think knowledge is very important. And this is what my expectation from our community is also. As a company secretary, we should create a lot of awareness about these issues. Sometimes they found trivial, small things, but then they blow out of proportion and go into media. The damage is irreparable.
Absolutely right. Yes.
Absolutely. Thank you, Jayant. I think we are running with time, running out of time. Right. And I think you are doing the right thing. You are creating a lot of this content, education, and all that. So thank you for creating all this. Please keep continuing this.
Thank you so much, Ravinder. It was a pleasure listening to you. And we look forward to more sessions from you as well. And thank you so much for coming on this discussion today. As always, I said, pleasure talking to you always.
Thank you so much, Jayant. And it was a pleasure to come upon this session and to be a part of this August platform, wherein at least 70-80% I could see were participating. There was active participation. It's a very good platform you have provided, actually, indeed. And I wasn't aware, honestly, initially, as I said that. But then when my team told me, I was very happy to be a part of this. I hope I was able to give certain inputs which were useful for the audience. That's what I'm.
No, there were definitely, yes. I am also going more educated today. Thank you so much for it.